Now, first to the big story of the day, the markets are selling off as the U.S.-China trade dispute deepens. Now, the International Monetary Fund is out with a study today stating that U.S. tariffs on Chinese goods have been paid almost entirely by American importers. Joining us now is James Liu, Clearnomics founder and CEO, along with Ashley Feng, a researcher at the Center for a New American Security. Thank you both for being here. James, we're looking at the market sell-off right now, Dow off just around 400 points. What do you think investors are focusing on today in terms of why we're seeing such a reaction in the broader markets?
Well, for most investors, it's been Groundhog's Day, not just today, but over the past year, and it's all about U.S.-China trade relations. I think the issue there, it's a big macroeconomic issue, and it can potentially have big consequences across the global economy. Right now, there is a question about whether a trade deal will get done. That's a shift from what we had seen even just a month ago, when it seemed as if a trade deal would get done. It would just be a matter of what are the level of tariffs and what amount of goods. So I think the markets are certainly more nervous today. That is why we're seeing the sell-off. Longer term, we do think a trade deal will ultimately happen between the U.S. and China. Obviously, there are a lot of issues that needs to get worked out between intellectual property rights, as well as the actual level of tariffs and what type of goods. But we're not yet seeing that trickle out into the overall economy like many people are worried about today.
Ashley, I want to get to that IMF study that I referenced right at the top there, just the fact that U.S. importers have been paying for the majority of these tariffs. This is according to an IMF study. Just in terms of what that means for the U.S. having leverage here in this trade war, does that diminish what the Trump administration has in front of them?
I don't believe so. I think that what has not been equally as reported on is how this trade war has also affected China. So China's economy has been slowing down over the past couple years, and Xi Jinping is in a position right now in which he really needs the economy to keep growing in order to keep domestic stability. So I would say that even though U.S. importers have been suffering the brunt of this, if you take a look at the Chinese manufacturing industry as well, they have also suffered a lot.
James, I mean, just in terms of what this could mean for the broader U.S. businesses, how they're dealing with this, if they are forced to pay more in terms of Chinese goods that are coming in from China, do you think that at some point we'll have a crisis in terms of confidence? We could see confidence here amongst many U.S. businesses begin to decline even further?
Right. So the key question here is time. How long will this negotiation continue? Earlier this year, we thought it would just be a few months by the time we reached a deal. And now, we're talking about quarters, maybe even years, that this could play out in the background and cast a shadow over the market. And the reason it's an issue of time is because it takes time for those costs to then get transferred out to other businesses, not just the importers, but also to actual consumers. And if you take a look at the original $200 billion worth of goods, very few of those were actually direct consumer goods. But now we may broaden that out and actually affect individual, customers and retailers and consumers out there in the country. So ultimately, if this plays out over a long period of time, it could in fact affect the economy at that point.
Ashley, how long do you think the U.S. can take before it starts affecting our economy?
I think you already see significant impacts. So not just talking about the trade deal, I think even after the trade deal is completed, there is still this escalating U.S. economic competition that will have effects for years to come. If you take a look at other actions, not just the tariffs, if you take a look at the recent reform of the Committee of Foreign Investment in the United States, CFIUS, as well as our recent export control laws, we added Huawei onto the entity list. And there are reports that other Chinese high-tech companies will also be added onto the entity list as well. So I think that even after a trade deal is reached, you're still going to see these effects, and you're still going to see more actions being taken by the administration. So I don't think we should just focus on the resolution of the trade deal as of right now.
James, just in terms of us trying to figure out what this means for the markets moving forward, markets have been extremely volatile. Is this something that you expect to happen until we reach a trade war or trade deal, excuse me? And then also, do you think that the markets are a little bit too optimistic that we will get a favorable deal at some point down the line?
Right. We do think that the market has increasingly discounted that possibility. So it's increasingly uncertain about whether that'll happen. And it's not just equities. I mean, equities are still up 14 or 15% this year. And so a 1.5% pullback, we have to put that in perspective. negative. But it's also, the credit markets and interest rates. Interest rates, the 10-year is close to 2.3%, the lowest we've seen in 2 years. And so it's basically affected all markets here. And, it's not just the US, it's emerging markets having pulled back over the last couple of months as well. So I think it's important to keep all this in context. The markets have done quite well this year. We are seeing a bit of a pullback because of this uncertainty, but we know why this uncertainty is happening. It's because of all these headlines that are taking place. That's probably not going anywhere. Investors should expect higher volatility, but we still generally do like the markets.
All right, James, Lou, and Ashley, thank you so much for joining me today.
Thanks, Shauna.